Silver crashes 22% in just 2 hours. What just happened to the market? 2 hours. That's all it took. Silver opened the session at $106. Within 120 minutes, it was at $82.70, a $23.30 collapse. A 22% wipeout in 2 hours. Not 2 days, not 2 weeks, 2 hours. I've been watching markets for over a decade. I've seen flash crashes. I've seen circuit breakers trigger. I've seen algorithmic meltdowns. But I have never, and I mean never, seen a major commodity lose 22% of its value in 120 minutes during regular trading hours with no major news catalyst, no geopolitical event, no exchange malfunction. This wasn't a normal sell-off. This wasn't profit-taking. This wasn't even panic selling by retail traders. This was something else entirely. And if you don't understand what just happened in those 2 hours, you're going to get destroyed when it happens again. Because it will happen again. Right now, as I'm recording this, silver is at $85. It's bounced $2 off the lows. But the damage is done. Thousands of traders liquidated. Billions in market cap vaporized. And most importantly, trust in the market pricing mechanism has been shattered. If you want to understand exactly what happened in those 2 hours, who was behind it, why it happened, and what it means for where silver goes next, hit that like button right now, share this with everyone who needs to see it, and let's expose the truth. This is the breakdown they don't want you to see. The timeline of the massacre. Let me take you through exactly what happened minute by minute, because the sequence matters, the timing matters. And when you see it laid out, you'll understand this wasn't random. 9:30 a.m. EST market open. Silver opens at $106.20. Trading is normal, volume is average. We're consolidating after the recovery from the $78 lows. The overnight session was quiet. Shanghai closed at $126. Everything looks stable. 9:45 a.m. EST, first warning sign. A large sell order hits the market. 5,000 contracts, 25 million ounces, dumped in under 60 seconds. Price drops from $106 to $104.50. This is unusual but not unprecedented. Some are calling it profit-taking from the recent rally. 10:00 a.m. EST. The avalanche begins. Another wave of selling. 8,000 contracts in 90 seconds. Price plunges from $104 to $100. This is where algorithmic stops start triggering. Momentum algorithms detect the breakdown and start selling. Retail stops at $102 and $100 get hit. The selling begets more selling. 10:05 a.m. EST. Freefall initiated. The floodgates open. Massive sell orders. 10,000 plus contracts hitting the market every 30 seconds. Price is in freefall. $100 to $95 in 3 minutes. $95 to $90 in 2 minutes. The order book is completely overwhelmed. Bids are getting pulled. Market makers are stepping away. 10:12 a.m. EST. Circuit breakers don't trigger. You would think at this point, with a 15% drop in 42 minutes, circuit breakers would halt trading. But COMEX has different rules than equities. There are limit up, limit down rules, but they're based on previous day's settlement, not intraday moves. So the crash continues unabated. 10:20 a.m. EST, the low silver hits 82.70, from 106 to 82.70 in 110 minutes, a 22% crash. The largest intraday percentage drop in modern COMEX history. Volume during this period, over 85,000 contracts traded, 425 million ounces. That's roughly 50% of global annual mine production traded in under 2 hours. 10:25 a.m. EST, the bounce. As quickly as it fell, silver starts bouncing. Short covering kicks in. Bargain hunters emerge. Within 15 minutes, we're back to $85. By 11:00 a.m., we've stabilized at 84-86 range. That's the timeline. From 106 to 82.70 in 110 minutes. Then back to $85 in 20 minutes. The most violent 2-hour period in silver market history. The 3 theories about what happened. Now, let's talk about what actually caused this, because there are 3 competing theories circulating right now. And the truth is, probably a combination of all 3. Theory 1, the coordinated short attack. The first theory is that this was a deliberate, coordinated attack by large institutions to crash the price and force liquidations. Here's the evidence supporting this. The selling came in waves, large blocks at precise intervals, not random panic selling. Coordinated dumping designed to trigger algorithmic stops and cascade liquidations. The timing was perfect. 10:00 a.m. EST is when European markets are starting to close and Asian markets are asleep. US liquidity is high but not at peak. It's the optimal window to execute a large sell program with maximum price impact. The sell orders were concentrated in the front month contract, March futures. This is where speculative longs are positioned. If your goal is to force liquidations, you attack the contract with the most leveraged positioning. Who would do this? The suspects are large bullion banks with massive short positions looking to cover at lower prices, Chinese entities coordinating shorts and COMEX while buying physical in Shanghai to widen the arbitrage spread, or hedge funds executing a sell America, buy Asia strategy. The motive is clear. Force weak hands out, trigger margin calls, accumulate physical at lower prices, and profit from the round trip. Theory 2, the margin call. Cascade. The second theory is that this was a liquidity-driven margin call cascade that spiraled out of control. Here's how it works. Silver had rallied from $78 to $106 in just over a week. Many traders who bought at $80, $85 were highly leveraged, using 10.1 or 20-to-1 margin. When the selling started at $106 and price dropped to $100, some of those leveraged longs received margin calls. They couldn't post additional collateral fast enough. Their brokers automatically liquidated their positions. That selling pushed the price to $95, which triggered the next round of margin calls on traders who bought at $90. They get liquidated. Price drops to $88. More margin calls, more forced selling. This creates a cascading liquidation spiral where each wave of selling triggers the next wave. It's a mechanical, algorithmic process that feeds on itself. No conspiracy needed, just leverage plus momentum plus lack of liquidity. The evidence for this, the speed of the collapse and the V-shaped recovery. Pure liquidation cascades look exactly like this. Violent down, violent up, no fundamental change. Theory 3, the Shanghai close arbitrage. The third theory, and this is the one most people are not talking about, is that this was related to the Shanghai market close and arbitrage positioning. Shanghai Futures Exchange closed their day session at 3:00 p.m. local time, which is 2 a.m. EST. Silver closed in Shanghai at 928 Wenqiger, approximately $127 USD per ounce. COMEX was trading at $106. That's a $21 premium, a massive arbitrage opportunity. But here's the problem. To capture that arbitrage, you need to buy COMEX, take physical delivery, ship to Shanghai, and sell. If you can't get delivery, the arbitrage doesn't work. So what do? You sell your COMEX longs because they're worthless if you can't convert to physical. And if enough arbitrageurs realize this simultaneously and sell at once, you get a 22% crash in 2 hours. This theory is supported by the fact that the crash happened shortly after Shanghai close, when arbitrage traders would be reassessing positions. It's also supported by the persistent Shanghai premium. It didn't compress during the crash, which means physical buyers in China didn't panic. The mid-reveal. All three theories are true. Here's what I believe actually happened. And this is the critical insight. All three theories are correct. This wasn't just one thing. It was all three happening simultaneously, creating a perfect storm. Someone, likely a bullion bank or coordinated group, initiated a large short attack around 10:00 a.m. They dumped 5,000, 8,000 contracts to push the price below $100 and trigger technical stops. That initial selling triggered margin calls on leveraged longs. Those forced liquidations created the next wave of selling from 100 to 90s. The cascade was now in motion. Simultaneously, arbitrage traders watching Shanghai realized the COMEX Shanghai spread is unsustainable if they can't get physical delivery. They start exiting COMEX longs, adding more selling pressure. All three forces converge in the same 2-hour window. Coordinated attack, plus margin cascade, plus arbitrage unwind around 22% crash in 120 minutes. And here's the kicker. The entities that initiated the attack knew about the margin call levels and the arbitrage dynamics. They deliberately timed and sized their selling to trigger maximum cascading effects. This wasn't luck, this was precision. The evidence in the data. Let me show you the data that proves this was orchestrated manipulation, not random panic. Volume analysis. 85,000 contracts, 425 million ounces, traded in 2 hours. Normal 2-hour volume is 15,000 times 25,000 contracts. This was 3 or 4x normal. And the volume was concentrated in the selling side. Massively lopsided order flow. Order book analysis. During the crash, bid-ask spreads widened from normal 1 to 2 cents to over $1 in some instances. Market makers pulled bids. Liquidity completely evaporated. This is a sign of coordinated selling overwhelming natural buyers. Contract distribution, 78% of the volume was in the March contract. Only 22% was spread across April, May, and June. If this was random panic, you'd see more even distribution. The concentration in March suggests targeted attack on leveraged positions. Time of day analysis. The crash happened between 10 or 10:30 a.m. EST. This is not when most retail traders are active. Most retail volume happens 8:30, 9:30 a.m. market open, and 1:00 to 2 p.m. lunch hour. The 10 a.m. window is when institutional algorithms are most active. Recovery analysis, the bounce from 82.70 to 85 happened on 60% less volume than the sell-off. That means the selling pressure was artificial and exhausted. Once the forced liquidations completed, natural buying quickly stabilized the price. Shanghai Premium analysis. During the entire COMEX crash, the Shanghai Premium widened from $21 to $44. If this was real fundamental selling, the premium would compress as physical buyers panic. But it widened, proving the crash was paper manipulation while physical held firm. The data is clear. This was not organic price discovery. This was engineered liquidation. The damage to market integrity. Here's what most people aren't talking about. The long-term damage this does to market confidence. Because when you can lose 22% in 2 hours with no news, no event, no fundamental change, people start asking, is this market even real? Think about it from the perspective of an industrial user, a solar panel manufacturer or electronics company that uses silver. You're trying to hedge your input costs. You go long COMEX futures at $106 to lock in your price for the year. 2 hours later, you're down 22%. Your CFO is calling, your risk manager is panicking. You didn't do anything wrong. There was no news. The fundamentals didn't change. You just got hit by a flash crash caused by algorithmic manipulation and forced liquidations. What do you do next time? Do you trust COMEX to hedge, or do you go directly to the physical market, pay the Shanghai Premium, and avoid the paper casino entirely? This is how markets die, not all at once, gradually, one flash crash at a time. Users lose confidence. They stop using the exchange. Liquidity migrates elsewhere. And eventually, the exchange becomes irrelevant. We saw this with the London gold pool in the 1960s. Central banks tried to suppress gold prices through coordinated selling. It worked for years, until it didn't. The pool collapsed in 1968, and gold was allowed to float freely. The manipulation eventually fails when physical reality overwhelms paper games. COMEX is walking the same path. Every flash crash, every margin hike, every delivery failure chips away at credibility. And credibility, once lost, is nearly impossible to regain. The 3 critical takeaways. Here's where we stand. Number 1, silver crashed 22% in just 2 hours from $106 to $82.70 with no news catalyst. This is the largest intraday percentage drop in modern COMEX history. 85,000 contracts, 425 Aussie, traded in 120 minutes, 3 or 4x normal volume. The crash was caused by a combination of coordinated short attack, margin call cascade, and arbitrage unwinding, all converging simultaneously. Number 2, this was orchestrated manipulation, not organic selling. The evidence: concentrated volume in March contracts, precisely timed selling at 10 a.m. window when algos are most active, widening Shanghai Premium, not compression, during the crash, and V-shaped recovery on lower volume. Someone initiated the attack knowing it would trigger cascading liquidations. Number 3, the long-term damage is to market integrity. Industrial users and institutional participants are watching 22% intraday crashes and asking if COMEX is even a reliable pricing mechanism anymore. Each manipulation event pushes more participants toward physical markets and away from paper futures. The London gold pool collapsed this way in 1968. COMEX is following the same path. The unresolved question, the tension that remains: we just witnessed the most violent 2-hour crash in silver market history, but the Shanghai Premium is now $44, up from $21 pre-crash. COMEX inventories are still at 34.6 million ounces and draining. Delivery demand is still at 14 plus million ounces per month. So was this crash the final shakeout before the squeeze intensifies? Or was this a preview of more crashes to come as the paper market dies violently while the physical market decouples? And most critically, if you can lose 22% in 2 hours with no news and no warning, how can anyone trust COMEX pricing anymore? How long before industrial users abandon paper futures entirely and go 100% at physical, which would make COMEX completely irrelevant? Final word: do your own research. What happened today was not normal. Markets don't lose 22% in 2 hours without reason. This was manipulation. Whether it was bullion banks covering shorts, Chinese entities gaming the arbitrage, or algorithms cascading liquidations, it was deliberate. The lesson is clear: leverage in this market is suicide. If you were long on margin and got liquidated at $82.70, you just learned the most expensive lesson of your life. The paper market is a casino rigged against you. The house can crash the price 22% in 2 hours whenever they want. But here's the other side. If you hold physical, you didn't lose anything. The silver in your vault didn't disappear. Shanghai buyers are still paying $127. The physical market didn't crash, only the paper price did. The divorce between paper and physical is accelerating. Each flash crash makes it worse. Each manipulation event pushes more participants away from COMEX and toward Shanghai, London Physical, or direct dealer markets. COMEX is dying. Not today, not tomorrow. But incrementally, with each 22% flash crash that destroys confidence, the question isn't if the paper market becomes irrelevant. It's when and how violent the final break will be. 2 hours, 22%. Remember this day, because it won't be the last.